Hello and welcome to another episode of the Ideal Investor Show. And I'm suspecting that a lot of our frequent listeners and viewers have already been waiting for us to bring on a person who can really talk to all the changes that have recently gone on in the leasing and renting market, and funding and crazy stuff is going on with interest rates and mortgages and adjustable, and are we going to have a bubble, and all those kind of things that have to do with how do we actually get the money to use for our investments. And so on today's show, we're going to talk to the president of Ridge Lending, Caeli Ridge herself, and she will give us a little bit of insights of what we can do in this changed environment and how we can position ourselves to still be successful investors. So I hope you're ready, because this is really going to be an amazing show. Hello and welcome to another episode of the Ideal Investor Show. Today with a guest that I have been waiting for quite a while, the president of Ridge Lending. That always sounds so good, Caeli. Caeli Ridge is with us today. How are you, Caeli?
I am very well, Axel. Thank you so much for having me. It's a pleasure to be here, truly.
Yeah, awesome. And I know that sometimes people say, oh, everybody knows Caeli Ridge and Ridge Lending, and they do real estate investing and lending and do it themselves and so forth. But I have rarely actually heard you yourself basically giving a little bit of a synopsis. How did Caeli get to where she is right now?
Ooh, okay. A quick synopsis. That would take us all hour, I think. So, 25 years. It's hard to believe when I say that out loud. We're a second generation company, and my father, Bill Ridge, started or founded Ridge Lending Services. He retired, I would say, sometime around officially 2005. I was running things a few years before that, but he was the one that actually had the brainchild idea of not wanting to compete with the real estate agents, the homeowners, right? Back however long ago that was. And he came across an individual that was an economics professor down in Southern California somewhere that was looking at VA loans at the time for real estate investors or VA properties. Anyway, they had a meeting of the minds and a light bulb went off, and Bill said, we really want to focus on this niche. We want to focus on investors. One, the industry doesn't really have a lot of experience specifically for that. And as you know, Axel, lending for a non-owner occupied or an investor versus where you're going to live could not be more different. So he just dove in and learned everything he needed to learn. And, it's an ever-changing, fluid thing anyway. And we continued to keep up with the times. And we made a name for ourselves. We did a lot of traveling, actual traveling back in the day, but there weren't podcasts, right? I was getting on a plane and staying at, a Ramada Inn or something and getting on a stage with 200 investors in an audience and giving the education about lending. So it took off and evolved from there.
Yeah, very cool. And I mean, I should disclose that I think, probably got like 8 or 9 different loans.
A lot.
From Ridge. So now one thing that I always tell my mentoring clients that they need to be aware that it's only the facilitation of the loan, because shortly after you're going to get a letter and Ridge will have, or not Ridge, but Geneva will have sold it to somebody else like Wells Fargo or Chase or somebody.
Right.
But yeah, that's basically, I think, how we came together, because I had a portfolio that I wanted lending on, and then another one and so forth. And that's actually been a little while. It's amazing how time flies. But what I wanted to touch on a little bit in our conversation today is, obviously there is a lot of noise in the markets about, are we going into a recession? Inflation is crazy high. The Fed is increasing rates like crazy and stuff like that. And there are a few questions that I come across from our mentoring clients that ask, and I think you'll be a perfect expert to maybe go into this. If I'm looking at the development of prices for renovated properties as an investor, where I used to always try to apply the 1% rule, and I'm comparing them lately to build-to-rent properties, basically new builds, that gap that used to exist has gotten smaller and smaller. But then the question is, okay, while the new builds are still a little bit more expensive, does it actually make a difference if I go to Caeli or another lender and try to get a loan as an investor for a new build versus a renovated property, as far as qualifying or getting the best rates or anything like that?
Not at all. There's no difference from an underwriter's perspective in getting someone a loan or securing an investment property loan whether it's brand new construction or it's, ground up or stud up, whatever, nothing changes whatsoever. As long as the comps are there, the appraised sold comps are there to evaluate the property, there's no difference whatsoever.
Okay, cool. And so now that we know that, how early in this process of a builder is basically in the process of creating the property, or an investor has bought the lot and wants to get the property built, how early can you start helping them?
The sooner the better, especially from a strategic standpoint, because we do spend a lot of time and energy and figuring out what their goals are. Everyone that listens to me talk, they always hear me talk about this roadmap, right? But creating a roadmap based on what their goals are today, what they want them to be in 5 years, and what their qualifications consist of, I think it's important to start that as quickly as possible, even if they don't have plans to close on their first property for 6 months, right? I don't think there's anything wrong with really getting that conversation going and building that outline. But from just a general perspective, I would say 60, 90 days before completion, right? Get all of our ducks in a row. We can even lock up to 90 days an interest rate if we think that's to the individual's advantage. I'm not so sure. Maybe we'll touch on, I'm sure, rates at some point here in the coming minutes. But I would say ASAP, no less than 60, 90 days, and maybe even longer.
Okay, cool. And do I understand this right? Then you're basically saying this applies for cases where the builder either has their own lender or they have construction loans or stuff like that. And we are basically waiting, if we're working with Ridge Lending, we're waiting for the builder to get basically permit to occupy and maybe even have property management in place and then, basically move forward. Or is there any way that somebody could maybe already get in the deal, so to speak, with the builder when the property isn't finished yet?
Absolutely. I would have everything gunned and ready to go so that we're closing within a small variant of time. Once we do have those things, right? The certificate of occupancy and all of those things, we're closing within a few days to a week of that. So the sooner you can have all of this work, and Axel, you're a prime candidate to explain to your listeners, you mentioned this, you threw yourself into the deep end. Right. And you assimilated very, very quickly the learning curve that you went through. So you know better than anybody how intense it can be, especially for somebody that's wanting to do and aggressively acquire. Really, they want to start as soon as possible.
Right. Absolutely. Yeah. I mean, I wanted to clarify this with an expert like you, because sometimes people say, well, couldn't I actually finance the construction, so to speak? Right. And there are cases that I'm aware of, but it's kind of like a special situation, especially if you're not a contractor or anything yourself. So I think the safe way is to say, okay, work with the builder, be under contract. And when you see that you're getting close to, permit to occupy, then, with a little bit of time ahead, get there. Now, with that in mind, I've seen deals lately where the question is, okay, so if I buy the lot, can the lot that I bought for cash be collateral somehow in the financing, and how would that work? Can you explain that a little bit?
Yeah, so this is, a lot of times there used to be lots and lots of construction loans, construction to perm loans. They used to be prevalent in the market space. 0809 kind of gave pain to that, no longer such a prolific product. However, I will just quickly mention before I answer your question, we will have ground up construction for investment properties soon. It's coming. It's been something that people have been asking me about for years. It's been very, very difficult as a direct lender, but one that you mentioned, we don't service our loans. We're reselling them on the secondary market after we fund them and underwrite them, whatever. So it's been very difficult to find the investors that want that to be in that space. We have several that we are kind of interviewing. So we should have ground up construction probably in the next 60 days to give myself a little bit of wiggle room. So that's coming, and I'm sure we'll talk more about that later. So in general terms, though, if the individual pays cash for the land, all that value and the cash that they have into it is going to be like a down payment. It'll be a credit as the overall when we start looking at the purchase price and the appraised value and then the LTV restrictions of the transaction or whatever the max threshold loan to values are. That will be a credit used for the buyer's down payment. And depending on what that price is, I've seen scenarios where they're actually getting cash back on a purchase, which is not something you would normally ever have happen, except for in that scenario where they've paid for this piece of property. I need to double check a guideline, but I think that they'll have to have owned the land for at least 3 months.
Right, yeah, which would make sense. I mean, I haven't seen anybody build a house faster than 3 months, right? So in a nutshell, if we were to go through an example, I think if you say, okay, there is a house that I'm signing for with a contractor, with a builder, basically, let's say for $300,000, and I bought the lot for 50, right? Mm-hmm. And on my 300,000, 20% down like we normally always do or try to do is 60. So basically, whenever you're then getting to the finish line of the build, you need to bring in another 10 plus closing costs and you're good to go. Is that right?
Exactly right.
Okay, cool. So that's because some people worry that, like, okay, is the house itself and the lot being looked at separately, right? Like as if the lot doesn't count. But I think we agree, or you agree, that that is the case. Okay, so if we zoom out a little bit from a more practical example into the market overall, and you kind of hinted in that direction, there's a lot of like speculation, is at least my impression, about, okay, is the market running ahead of the Fed and is already kind of like peaking out, or if we get another 0.5% or 0.75% rate increase, will mortgage rates continue to go up? What's Caeli's take on the trajectory, let's say, for the next few years?
I hesitate to focus on anything longer than the next few days, but if I'm forced to kind of look at, let's just say the next 12 months, okay, I'd be willing to kind of put my reputation on the line for that. I think the Feds are going to continue to increase rates at a clip that is in line with the inflation concerns. But I think also, housing is a cornerstone of the United States economic infrastructure, right? It's a very big piece of that. And I think that they're really going to make a point to ensure that more inventory is on the market. So that increase in rates is going to create some of that. And as a result, the simple supply and demand is going to drive values a little bit lower. And I've been talking a lot about this, and I want to be careful not to oversimplify it or create an impression that I mean that housing is going to fall through the floor. That is not what I'm talking about. But if anybody's been paying attention, and I know you have, Axel, a 30% annual appreciation rate on average in the US is not sustainable.
Right.
If we keep that trajectory, we're going to have much bigger problems than what we think we have now, right? That's going to create catastrophe crashes and bubbles and whatever. So I think that the easing and them coming down a little bit is a good thing and a natural cyclical projection, or it's what's supposed to happen. So as a result, I think as investors, that's really going to be of great value, more so than a homeowner, because even if the values come down a little bit, rates are going to continue to go up. They're going to be bought out of being able to qualify and buy their owner occupied. So we should be prepared to take advantage of the extra inventory. We're not going to be bidding against 20 other people and the lower price points, and negotiating a little bit more with sellers, right? The sellers market that has been fierce. I don't know, Axel, if you experienced any of this, but did you remember making bids on properties over and over and over again just to get bid out by somebody else? Did you have some of that when you were?
Not really, because we mainly work, as you know, with turnkey providers. So there is really, I would almost call turnkey investing like off-market investing, because it doesn't go to the MLS. It's not really very much known unless somebody is hooked up at the hip with the turnkey provider. Like even in the locations, and I know that you work with a few of them as well, at least on the lending end, those properties, the community oftentimes doesn't really know that the property is going through a renovation and is ultimately coming on the market under the ownership of the turnkey provider. So yes, you basically compete with other investors, but it's not dozens and dozens. It's like maybe 2 or 3. And yes, there are some people that did some things that I kept myself and our clients away from. I never felt comfortable that turnkey providers or other entities that offer investment properties basically wanted to bid or wanted to enforce the property is only available cash only or stuff like that, right? I have advocated really literally in up to the point to talking to the CEOs of some of those turnkey providers to appeal to them to realize that their business, if they really truly want to do, like when I talk to the Spartans of the world or the Freedoms of the world or so forth, when you look at what they claim on their websites or when you talk to them, it's always, we want to run a long-term business, build a long-term portfolio, have long-term relationships. And so I asked them, how does that jive with you instituting things like cash-only purchases? And then the argument is, well, if I have to wait for Caeli to get her loan and the appraiser and everything together, my cash buyers have already bought the next property. Well, that might be true until the cash buyers are gone, and then I'm gone too, because when the relationship is ruined, my grandpa always said, Peter Drucker, by the way, said the same thing. I don't know who got it from who, but, it takes sometimes years and years and years to build a relationship and a reputation, and in 10 seconds or 50 seconds, or you fill in the blanks, it can be gone, right? So if a turnkey provider disappoints the potential investors or somebody that I refer to them, I wouldn't continue to go to that, right? So I appealed to that, and we didn't really have to compete in that sense with tons and tons of people. But a few clients actually tried to go on the open market, just regular MLS, Zillow, Redfin, that kind of stuff. And it was basically impossible because people were not only bidding up the price, but what is also oftentimes misunderstood is when we go in and we want to do like a 20% down, 80% finance, and you're competing with somebody who can basically go with 5% down or 8% down or 10% down or VA 0% down, right? Then their way of getting into a deal, if it's financed, is a little different than for an investor, right? And so long story short, what we found is that you needed to become more and more and more selective, because this initial trigger, we want to find properties that are well performing, and just as a starting point, let's see if we can get close to 1% rule. That got harder and harder and harder, obviously, because the rents didn't and still haven't really caught up to the price increases.
Yeah.
So with that being said, one thing that I'm curious about, and I want to let the audience know that Ridge Lending also has like a little Tuesday soiree or something like that, or what do you call it?
Oh, I like that. A soiree. I love that. Yes, that's so great. Our community. Yeah.
Our community. And I'm every once in a while when I can make it, I come in there. And we have a little bit had a discussion lately there about, what other instruments of financing can we use? Should we go to interest-only loans? Should we dig out the old adjustable rate loans and stuff like that? And this goes together with my point of how long is the arc, right? I know you said you wouldn't want to go longer than 12 months. I'm willing to say, I think that the realization that $30+ trillion of national debt and how much it costs to serve that debt when interest rates for the Fed are in the 3 point whatever range, and that also means treasuries are going to be in the short and medium, and I don't think they use long-term treasuries, are going to be in somewhere in that range. Like right now, they're at 2.9% or something. Well, the government used to pay 0 point something. Now they're going to pay between 2.5% and 3.5%. That's 8 times as much. My projection is we can't sustain 7, 8, 9 times the interest payment per year on our debt. So what is politically opportune right now to say we need to increase interest rates to get inflation down is not very long sustainable. So my time horizon, therefore, is I think 3 years, 4 at the outside 4 years.
Before rates come down.
Well, yeah, before it's coming down to something where you would say, okay, if I get like an interest only or an ARM, which I know you told me still needs a little maturation again. But when somebody does this, let's say in the next 6 months, I would say you have to have that for 3 years. And then probably you're going to get back to maybe not ever to where we were, but at least to something closer to reality.
Yeah.
So I'm kind of wondering how you see the different other instruments, and maybe you can tell the audience a little bit of what's available there and what to look out for.
Sure. I agree with you. I think that on the long end, probably 3 years, I would say, when we start to see interest rates come back down a little bit, I don't think it's going to take that long. By what margins, right, they're going to come down, I would be less inclined to offer that advice. But I do think we're going to start to see them soften in the next 12 to 18 months, maybe sooner. There's too many variables for me to try and predict or account for. And if I did, it would be a falsehood. I'm smart enough to know what I know, but people a damn sight smarter than me get it wrong all the time because of all those extra variables that you can't predict for. Anyway, so I think that we're going to start seeing interest rates come back down next year, year and a half. I do think that ARMs are going to become a lot more mainstream. They have been out of the spotlight for so many years now. I think ARMs are going to be here to stay, which I am a huge, you and I have talked about this, huge fan of the ARMs, very big fan of the interest only, especially for investors. So I hope to see those kind of open up in a more broad range, and the margins between that we want to see between a 30 and an ARM really start to get that nice padding, right? A point, maybe a 1.5 difference. Not quite there in most cases, but we're getting there. It's starting to narrow.
Yeah, I see that too. And I also agree that I think the split, if you have like a 30, I don't know, let's just say 6%, and you do like a 5 or maybe 4.
If you can, yeah.
But the point is, what I think is helpful for the audience to understand is, it's basically, and I think this is an important general realization about this whole investing game, in a sense, is that everything happens in cycles. right? So if you say, okay, in 2022 or 2023, I get a 5-1 arm, and Caeli is right, in 18 months, interest rates come down. The only thing that happens is that your current rate is staying until you reach that 5-year point. And then when they say every year we renew, if it's a 5-1, once a year we look at what it is and it gets adjusted down. Right. So you wouldn't even have to do something unless you say, well, I don't want to wait. Caeli was right. It was only 18 months. Well, then I refi after 18 months instead of waiting 5 years. I think it's a very good instrument. And I think I told the story in one of the Tuesday calls where everybody called me an idiot in, I think, 2004, 5 or something, when I did a 7-1 arm at the time, 2.9%, which everybody said, well, you will see where that ends up. And it stayed and stayed and stayed and stayed. And even when it adjusted after 7 years, it adjusted by like 0.1%. But the whole time I was paying way less than all these people who had signed up for 6.25% 30-year loans and stuff like that. So
it's a good story.
And the point is, I think, importantly, why are we doing the investing in the first place, right? I always say we look for well-performing properties to generate cash flow so that we ultimately get to a passive income number that allows us to decide, do I want to keep exchanging time for money or not? So what other things, if somebody were to say, well, I don't know, or interest only, any other ideas or any other suggestions? If somebody were to say, what else can you give us, Caeli?
Well, we have a whole very diverse loan matrix of products for our investors. The one that I really, really love is that Velocity Banking and Infinity Banking, the all-in-one. And I can't remember, Axel, if we've spoken in any great detail about this, but it actually kind of encompasses with quite a few extra layers of conceptual understanding needed. But you've got an ARM and you've got an interest only that's in the form of an open-ended. Now, this is, for a lot of people, this is, mind-blown stuff. We think about our 5-year ARMs or our 7 years or whatever it is, and maybe even an interest-only component connected, but those are amortized, well, interest-only for a period, and then amortized closed-ended, right? It's closed-ended. Yeah. The all-in-one is another product that we have that I think for the right individual, and in particular, the right investor, there isn't a product that I can think of that can beat it. It's open-ended, okay? Think amortized or interest-only closed-ended versus open-ended revolving, where I don't know how far you want me to go down this rabbit hole.
Yeah, I always compare it a little bit to, like, in a sense, line of credit or a credit card, in a sense, because that open-endedness, there's a similarity to a home equity line of credit, right? Because you basically have a card that has a certain amount that you can go up to as a maximum. And depending on how much you use and how much you pay back in, you can play within that balance, basically.
Right. And it's mortgage interest, which is deductible, right? If it's used for investment or home improvement, right? It's not deductible if you're out there buying boats and going on European vacations, but it would be the same rules the IRS imposes. So you've got the mortgage interest that's deductible. Yeah, nothing changes about your spending habits or anything. You're simply taking depository income, especially for investors who have maybe 10 grand of gross rents, not net rents, but gross rents that are just kind of sitting around, and you can pull it from the big boy bank and throw it in this open-ended line of credit where your balance dollar for dollar goes down. So there's a compounding effect of interest savings in doing that. And it happens every single month. And then what you're not using, again, stays in there. Nothing changes about your spending habits. You still have 24/7 access, but now you've become your own bank. You get to choose how much interest you're paying and then how you want to leverage it back out and what you want to use it for. I'm simplifying ridiculously, but it's probably one of the coolest tools I've seen for the right real estate investor. I love it.
Yeah, I think it's a very good tool as well. And especially when we keep in mind that these money transactions are not money that we need to earn as income. This is typically money that comes in from the shelter that we're providing, meaning the houses and the tenants that pay us to be allowed to use them, right? So that's an important component. Now, one thing, if I remember right, and correct me if that has changed, but I think you once taught me that the all-in-one, you can do one basically for an investment property and one for yourself. Is that still the case?
It is. Prior to the pandemic, you could get up to 6 of these. However, 6 all-in-ones for one borrower would have to be a very unique situation. You'd have to have an insurmountable amount of monthly depository income that you had access to take 6 of these and take, let's say you had 10 grand a month of deposits that you had access to, and parse it out over 6 of these loans would defeat the purpose.
And the reason I wanted to confirm that setting or that 1+1 is basically the case is I think because it's such a unique and valuable tool, I wonder what you would say kind of like the investment value should be. I mean, I can't imagine that it really makes much sense to do that on an $80,000 investment, right? I mean, so I'm wondering, where would you say, is it like more when you have like a 300,000 deal or 350 or 450? Where would you say, okay, it should be at least that to take your one silver bullet for that, so to speak?
Yeah. Well, so just to clarify guideline, you can have up to 3, technically. You can have one on a primary, one on a second home, and one on an investment property. So technically.
For all the millions who have one in a second home.
Right. So generally speaking, depending on circumstances, we want to put the all-in-one on the property that's going to give you the highest line limit. So typically that's going to be the highest valued property. A lot of times we find that in their primary residence. This is going to be confusing. Cross-collateralization, right? Where you're taking multiple properties and putting them into kind of one blanket loan. While the all-in-one is not going to encumber the county, it's not going to be recorded and encumber multiple properties, you can still do the same concept with one all-in-one on one property, whereby that is the blanket loan that you're going to take if there's enough spread between what you owe and the line limit for the highest value property, and pay off other mortgages over here, and you're housing it here, right? Now, there's a whole other conversation there. Do you want that debt equity sitting there? Probably not. Right? If you pay off this mortgage, now it's this free and clear property. I don't know.
That's like you said, that gets into the depths of cross-collateralization and really looking into the rules, because you could say, okay, well, if the mortgage is paid off, can I get a HELOC, right? And does it have to be second lien or can it be in first position and stuff? There's more layers behind there. But
absolutely.
So would you be willing to give a minimum number that somebody should basically consider the all-in-one for?
The highest that you have. Right. It'd be impossible to have a minimum necessarily because it's so individual. So whatever your portfolio consists of, including your primary, I would argue, unless you've got a 1% 15-year fixed mortgage, right, the all-in-one's probably going to kick its butt. But I would say that if you look at your portfolio, the one that has the highest appraised value or the highest value of the property, unless that's completely tapped, and even then, maybe that's what we consider. I'm being a little bit vague, but typically you just want to put it on the one that will give you the highest line limit because it gives you the most access.
Yeah, absolutely. And I think there's probably most likely, especially with a lot of appreciation that we have seen in the last few years, that it is the primary residence. But people, if I understand it right, need to keep into consideration, at least I've seen this with some of our clients, that they have actually smartly tapped into the equity that has grown on it by just getting an appraisal for $500 and then get a HELOC on it. So if you already did that, then you might have to have a call with Caeli directly and go through your specifics on how that looks like. So I think it's just important for our audience to know, okay, we were all so conditioned that you either made a decision, okay, do I go 30 years or 15 years traditional mortgage and keep going and adding and adding and adding, and maybe every once in a while refi when the rates came down. And we are now obviously in a different environment where we need to be flexible. We need to be looking at what are the different instruments and how much do they cost and under which circumstances do they make sense. So is there any kind of, like, before we get to the last 2 questions I always ask, but is there any kind of overarching message that you want to send out for people who say, or ask themselves, is it still the right time to invest in residential real estate, or should I wait? Are we at the peak? All those kind of things that we hear in the media.
For my money, I think that real estate is the foundation of my wealth and what I've been able to amass. I think diversification is always important. Stock market and educating yourself is important, but I can't think of a better time that there is been in history to buy real estate. And I would be saying that 5 years ago or 10 years ago or 10 years from now. I just think real estate is a bedrock, and it's always going to, for the long term and even short term fix and flips and the ever changing economics of it, I'm very bullish on real estate. I always have been, and I probably always will be.
Yeah, me too, obviously. And I think when it comes to diversification, what I lately put in our newsletters and our messaging is, if you want to diversify, that's great, and you should, as long as what you diversify in is value assets, right? And value assets can be gold and silver coins. You could even be venturous and say, I go Bitcoin, but no other cryptos, only Bitcoin for reasons. And people, if they want to know, can ask me why. Or real estate, for example, those kind of things. Some people go into things that they claim to be valuable, like art. that is in the eye of the beholder. But all this other stuff where you're basically dependent on the performance of other people's work, right? Like, for example, stock markets. Good example right now is if you look at all the companies out there and you say who is performing, has price power, is selling every item that they can make, and then have a list of 1 year waiting list. One of those examples would be Tesla. Yeah. But they're basically treated the same like any other automaker, and every automaker is in the dumpster right now by stock price, not by performance, right? That is basically saying the prettiest house in the neighborhood is basically the same value like the shittiest house in the neighborhood. Right. And we all know that's just not true, and it wouldn't be fair. But I say, don't even go there, stay away from it, do the things that are obviously and fairly valued, and you should be fine. Cool. Well, with that being said, the first of those last two questions is, if you could meet anybody, Caeli, who would it be and why?
I knew it was going to be something like this, and I try to think of all the different scenarios. What are those questions that are going to ask? And somebody's asked me this before, and I didn't have an answer. Let me just think about who would I meet and why. The first person that comes to mind is Barack Obama. Okay. And I think that because of his tenure and where he started and where he ended and what he saw happen afterwards, I'm such a big fan of his philosophies. And while not perfect, I always really subscribed to the way he could take the most difficult situation and find an appropriate response and middle ground for things. I mean, he was such an articulate human being. I don't know that we've ever had a president that was more articulate, but I would really love to sit and talk to him and hear his thoughts on, especially from when he left office to, the last 8 years. Has it been 8 years? 12 years?
Right, yeah. I mean, basically, there was Trump for one run, and now we have 18 months of Biden. So 5.5 years or so.
Yeah.
Like that. Yeah.
So I would be very interested to sit down and listen to him talk about that or anything, to be honest.
Yeah, I would come along. I would also be interested to hear or ask. I would be blunt and just say, Mr. President, any regrets of the things that you initially said you wanted to do and then for whatever reasons didn't feel to push hard enough or whatever to ultimately do them, and then see what has happened since.
Yeah.
And by the way, on the articulate, I would say probably Bill Clinton would be the same.
Another one, yeah.
Yeah.
I don't know that we can say that about all our presidents.
I'm not talking about content. I'm just saying communication.
Yeah.
All right, cool. Well, the second question is, if you had a time machine and you could go anywhere, you know what you know, you can come back, you just can't change the space-time continuum, where would you go and why?
I think that I would clock it for right now today with all the experience that I know and be able to make those informed decisions. I think I would just be right here, right now.
It's allowed. It's on the spectrum, so you can be anywhere. It can be.
What about you? You've answered this question, obviously.
For myself, one of the things is I made a few decisions. So it's not really necessarily just one point, right? And I would love to go back because I can't really, for the life of myself, remember, for example, exactly what made me buy my first house or what made me decide to accept the opportunity to leave Germany and come to the United States. And there were a few others like that. So I would kind of slowly come back and stop at these points and say, what the heck were you thinking? And I know I couldn't change it, but it would be kind of enlightening to know what went through.
Yeah. Was that part of the question, though? You can go back anywhere. You can't change anything that you did, but just to go back and revisit.
Yeah, I didn't used to say this and left it all totally open. And then people say, well, I just look at what the numbers are for the lottery winner and then go back to that year and stuff like Powerball and what have you.
I think a lot of people would instantly want to go back and change, a decision that they had made or whatever. I've thought about that because I've made some bad decisions, but coming out of those, I recognize, and I'm such a big believer of this, those learning opportunities are just invaluable. And they've been very invaluable to me in my life. And to go back and erase those mistakes would serve no purpose for me whatsoever.
Right? Yeah, I wouldn't want to erase something either or anything actually for that matter. On the other hand, I have to say, when we didn't have that limitation of not being allowed to change something, I've always in my brain felt tempted to say, is there any way to influence anybody to start having financial education in school, right?
Yeah.
And I don't think that would be something that would be horrible. I would actually rather think it would be awesome if people had much better understanding on how to deal with their money and what they can do with their money and all the rules that the government is actually giving us and benefits it's giving us. I mean, I don't really, honestly, a little bit on the personal side, Caeli, I don't understand why somebody who is a successful investor is nowadays vilified in the media, right? Especially when we look at what you're doing, what I'm doing, what people in our community doing, is we're not investing because we're just out for the pure profit. I would at least say this for myself, but we want to give people good value for their money when they live in our shelter, in our houses, right? And why that is somehow a bad thing when we know that everybody needs a place to live, right? I mean, I'm just lately joking that the caves have just gotten a bit prettier, but we started in the caves and we have prettier caves now, but we still need to live somewhere, right? And so to put this into like these evil billionaires and millionaires and successful investors is a little sad to me, to be honest.
I agree. I think you're right. I can't think of anything more valuable than to educate the youth, right? If I had one challenge in my day-to-day stuff, it's figuring out a way to get the real-time information, because I said before, it's ever-changing, and be able to get that to the masses and the people that would be able to use that tangible information. I haven't been able to figure that out. So I think it should start way, way early and
right, exactly. Yeah, I mean, one cool investing tool from a lending perspective that I've spoken about a bunch of times, and I'm assuming it's somehow not possible, would be to have something where the investor would have a more obvious benefit from allowing people to do like lease to own. Right? Because I would love to be not just an investor, but to somebody who is a tenant to literally have the opportunity to become the owner of the property. But everything that I've seen in that field is basically very compartmentalized. It doesn't really look at the journey where you say, okay, for me, if I could say, okay, how about you sign up a 6 or 5 or 7 year lease agreement, and then it's down to so little that your rent is basically covering what it would be if you own it, and you just keep going. And I basically, in the meantime, get enough on the profit side so that I can exchange that property into another property and you keep the remaining property, right? Something like that. I haven't found that is available in a way where it's not too one-sided, where the investor is basically shouldering all the responsibilities and all the financials and the tenant is just paying the rent. But that would be a cool thing, because I think it would help us to help people to basically get on that journey to homeownership.
I agree. It used to actually be something that we looked at, and it was a pretty common part of our practice, where we would have investors that had their exit strategy in 5 years. They sold it for this price here, and they put in their appreciation, and a percentage of the rents that were being paid every single month were going to go into the kitty as their down payment. And their contract at the end of 5 years, that they would be ready to refinance. The owner would put the tenant on title with certain provisions. Now, there may be some differences of opinion in doing that, but at the end of 5 years, they have to refinance. And there was even coaching about how to get their credit built up so that they would be able to do this. I agree. I think it's fantastic.
Yeah, or even go out and do like an owner financing, but then the lender, on the other hand, would have to be willing to kind of, honor that in some way, because then if you look at an environment right now where, we have low interest rate mortgages on properties, why shouldn't a tenant be able to carry those forward and then, somehow still be able to 1031 out of the property as the investor? This is kind of a little bit vision of what I'm thinking about. How could this whole thing become more of a social cause rather than just an investment for those who can afford it, right? But
yeah,
that's maybe our next conversation, Caeli. Maybe.
Well, they used to have assumable loans. Maybe I'll start digging into seeing who out there wants to reconsider assumable loans, because that would be the answer.
Yeah, and then you and I start a movement.
Let's do it.
Yeah, that sounds good. Well, before we do that, how can people get a hold if they now feel intrigued of all the different options that you mentioned and how they can get their lending so they can become investors?
Yes, thank you. So there's several ways. You can go to our website, ridgelendinggroup.com. You can call us at 855-747-4343. 855-74-RIDGE is an easy way to remember, or you can simply email us at info@ridgelendinggroup.com, and we'll be here on standby.
Yeah, awesome. And we're obviously going to put all those links and numbers and so forth into the show notes, so it's easy, and on the YouTube video and so forth, so people can find it. Any last message you want to give to the audience?
Get ready. The tide is turning. If you've got debt equity sitting somewhere, get it out, get it harvest, get ready, because now is going to be a very good time for investors to start taking advantage of the next cycle. It's here. It's upon us.
Awesome. Okay. Well, thank you so much for being on the show, Caeli, and I hope we can do it again.
Thank you, Axel. My pleasure.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.